Hello, everybody. Welcome back to the Polaris Energy Finance Podcast. This is Terry Rumbold. Thanks for tuning in. All right. So today, we're not just doing headlines. We're going to delve deeper into some capital structure analysis, obviously disguised as your favorite podcast. We've got a few developments in the industry that I wanted to cover in this episode. When you zoom out across power, oil and gas, mining, batteries, and nuclear, all the topics we're covering today, what you're actually seeing is a repricing of physical infrastructure in the context of global reorganizing of critical mineral supply chain, AI data centers. And the interesting thing is that it's not necessarily a linear progression, if you will. It is very dynamic developments across industries that are intertwined with global economics, geopolitics. A lot of the companies are optimizing for resilience, security, and return on invested capital. Let's start where private capital is placing $1 billion bets. Okay, BlackRock Global Infrastructure Partners is teaming up with EQT to bid for AES, which is a company with roughly around $10 billion of equity value and about $43 billion of enterprise value, including debt. And it really is not an opportunistic M&A. It is a statement that infrastructure funds are not buying optionality narratives, and they're buying duration and contracted cash flows, which, again, AES as an energy company does have, especially given its impressive renewable fleet of generation. Now, here's the analytical layer. AI-driven data center demand changes the forward curve of power demand. So if hyperscaler demand is growing at double digits annually, and each data center requires 100 to 300 megawatts of continuous power, then you're not talking about peak capacity anymore, right? You're talking about baseload. And when baseload grows structurally, regulated utilities and diversified power producers re-rate. So private capital understands that PPAs, or power purchase agreements, create quasi-fixed income streams, right? And inflation linkage protects real returns. Replacement cost of generation assets is again rising, and permitting constraints, as we talked about in the last episode with interconnections, etc., are creating scarcity values. So a $43 billion EV bid isn't really about, its current earnings, and it's about locking in 20 years of cash flow visibility in a tightening capacity market. And this is infrastructure, again, becoming very strategic globally and in the US. Okay, let's zoom out. If private equity is bidding for generation platforms, what's happening in the generation mix itself? In 2025, the US nearly tripled its gas-fired capacity in development to approximately 252 gigawatts. Now, if that's built, that expands the existing US gas fleet by nearly 50%, requiring over $416 billion of capital expenditure. So when you unpack that, the 252 gigawatts really is not the marginal value, but at a 60% capacity factor, that implies roughly 1,300 to 1,400 terawatt hours of potential incremental generation annually. So that would require material incremental gas demand. That incremental gas demand would really put structural floor under upstream gas volumes, midstream infrastructure utilization, LNG export optionality. And when you think of oil and gas, obviously one would think of Texas. So Texas alone now accounts for 80 to 81 gigawatts of that said pipeline in development, with nearly 40 gigawatts directly tied to data centers. And Texas now has more gas capacity in development than every country except China. So this really is a reliability premium for a lot of these developers and also data center operators, because renewables are still growing, but AI workloads require uninterrupted voltage-stable power. And also, just on the upstream material perspective, turbine supply constraints are extending to 2030, and that tells you something important. Even if capital wants to build, equipment bottlenecks are limiting speed. So really, you add scarcity to demand growth and you get pricing power. Gas is being repriced now, not really as a legacy energy, but interestingly enough, as digital infrastructure. And that flows directly into oil and gas consolidation. So, speaking of oil and gas consolidations, Devon is acquiring Coterra in a $21.5 billion all-stock deal, which includes $58 billion of debt, creating a company producing 1.6 million barrels of oil equivalent per day. So the expected synergies is that $1 billion annually by 2027. Again, much like the other M&As in natural resources, this really isn't growth for growth's sake. I think they're doing a lot of inventory math, right? Shale wells decline fast, so inventory depth determines long-term free cash flow visibility. So by combining permanent exposure, multi-basin optionality, and operating efficiencies, Devon reduces per barrel lifting costs and extends drilling runway. So and investors today really care about your free cash flow yield, return of capital, and debt discipline. Not necessarily production growth, right? And scale of that reduces volatility. And when oil prices fluctuate, which they will, larger diversified producers absorb those shocks better. So this deal is about lowering cost of capital through operational stability. Meanwhile, Europe is dealing with its own reckoning. We're really heavy on the oil and gas in today's episode. BP suspended buybacks and cut capital expenditure to no more than 13.5 billion from 14.5 billion US dollars. And net debt is above 22 billion, with divestitures targeting around 20 billion by 2027. So what is this telling us? For BP, the renewable pivot did not generate competitive returns relative to oil majors that stayed really disciplined in their field, and markets punished complexity and underperformance. So now BP is really retrenching, reducing leverage, and prioritizing cash flow. So in other words, it's re-earning credibility. The energy transition hopefully is not dead, but capital markets are demanding that it generate returns above your cost of capital, and that discipline there continues in mining. All right, so we're moving on to the fifth headline of the day, which is that the U.S. is launching a $12 billion of critical minerals stockpile, which includes $1.67 billion of private capital plus $10 billion in U.S. XIM financing, which is signaling something very profound, especially in the global critical minerals supply chain, in which China controls 90% of rare earth processing. One would think that really is just market dominance, but China is also able to leverage that. And minerals like germanium and gallium are inputs into semiconductors, night vision devices, solar cells, and advanced electronics. Ivanhoe's Kipushi mine is currently producing 240,000 to 290,000 metric tons of zinc concentrate, plus strategic byproducts, and it becomes geopolitically relevant. Think of it as like a commodity securitization. We have strategic petroleum reserves, but the $12 billion critical mineral stockpile is essentially for the electrified economy and national defense security and energy. So when governments stockpile, they reduce price volatility and create implicit demand floors, and that stabilizes financing conditions for mining companies to go in. So mining finance is shifting from like a hopefully cyclical speculation to quasi-industrial policy alignment. And again, on a global scale, though, the cyclical speculation would still probably play a big part, but this effort is also a signaling I want to shift away from that. Okay. All right. Who wants some gold these days, especially in this economy? Barrick spinning off North American gold assets that account for over 60% of its over 3 million ounces produced last year. And the fourth quarter revenue of Barrick was up by 64% to $6 billion, with net earnings at around 2.4 billion US dollars. So they're targeting around 50% of attributable free cash flow payout. What's happening here? When commodity prices rise, conglomerate discounts widen, right? Activists push for structural clarity. A partial IPO in that sense crystallizes value, like what Barrick is trying to do, and it narrows valuation gaps and improves multiple transparency. Gold's rally has strengthened balance sheets. Now companies are optimizing structures while prices are high, and if you've been keeping up with commodity prices every day, you are up to date with what Barrick is trying to do strategically here. And that's a capital discipline in a commodity upcycle. But let's talk about silver now. Silver surged over 250% in a year, reaching $114 per ounce before plunging below $80. Solar, renewable energy. Solar represents 17% of silver demand. And silver now accounts for 15 to 20% of solar cell manufacturing costs, up from 5 to 7%. Tongwei Solar, which is a Chinese company, is expecting to lose up to $1.4 billion because of this. And this is a reminder that commodity volatility transmits into manufacturing margins. So when speculative demand drives prices faster than the industrial substitution can respond, you get profit warnings, technology substitution, margin compression. Think of the stockpile that the US is trying to create in this sense, that how this case study is proving the importance of, not even the importance of, but how cyclical commodity prices can have an impact on your manufacturing and ultimately a strategic goal of a country when it comes to energy or defense or electrification. Silver becomes a tax on renewable manufacturing because of that. Okay, so what's happening in battery storage? 10 North American battery plants are shifting from EV cells to energy storage systems. Tesla Energy and Storage revenue was up by 27% to $12.8 billion, and EV revenues down by 9% to around 64 billion US dollars. And the 2030 EV penetration forecast cut from, hear this, 48% to 27%. So storage is becoming a grid infrastructure, and data centers require backup capacity, frequency regulation, load smoothing, but also batteries are becoming balance sheet assets for utilities and tech companies in tangent to that. And policy incentives plus tariffs narrow cost gaps with Chinese imports, hopefully for the US market. And manufacturing capacity is reallocating towards stability revenue rather than consumer cyclicality. Some interesting developments in nuclear happening as well. Goal really is to quadruple U.S. nuclear capacity by 2050. Cameco, which is a nuclear company, is up by 395% since 2023. Centrus awarded $900 million to the company to expand its enrichment. And in a larger global context, Russia supplies roughly 1/4 of U.S. enriched uranium imports. So nuclear is now being reframed as an important agenda for energy security, industrial policy, and carbon-free firm power. Yes, that valuation for Cameco is very high, but markets are pricing long-duration demand visibility, and advanced reactors require HELO, and domestic enrichment in that sense becomes very, very, very strategic. So when government guarantees demand, equity multiples expand. All right, so that was today's episode of Polaris Energy Finance Podcast. Let's go through some high-level thoughts here. from today's episode. Power demand is structurally rising because AI is not cyclical. And responding to that, gas is expanding because reliability has pricing power. And oil and gas consolidation is about cost of capital discipline in that sense. Mining is also aligning with geopolitics. And gold miners are monetizing premium multiples. And silver volatility is exposing the industrial fragility within the big metals and mining industry. And in energy, battery manufacturing is pivoting towards grid economics, and nuclear is being repriced as strategic infrastructure, and valuations and stock price increases are reflecting that shift. So if you're building a career in energy and mining finance, this is the environment that will define the next decade. So hopefully you understand return on capital, understand supply chains in both critical minerals and energy manufacturing and raw materials. Also understand geopolitical risk premiums as well as how policy shapes your cost of capital. And because energy finance today is macroeconomics expressed in megawatts and metric tons and fancy industry language, knowing all of these contexts would be very helpful. And that's what we'll keep unpacking on Polaris. Make sure you hit that subscribe button if you haven't subscribed yet. Turn on notifications so you don't miss an episode when it gets out. And wishing you a great rest of your week, month. We'll see you in the next episode.